All right. Welcome, everyone, and thank you for joining us today for our program, Compensation Trends in M&A Transactions. My name is Allison Carlon, and I'm an associate in our tax section at Mullen, based in our Richmond office. As a member of our employee benefits and executive compensation practice, I advise employers on the legal aspects of employee benefit and executive compensation matters arising under ERISA and the Internal Revenue Code. Today, I am joined by Nona Massengill.
Thank you, Allison. Good morning, everyone. My name is Nona Massengill. I'm also based in our Richmond office. I'm part of our employee benefits and executive comp team, part of also our larger tax group. We're going to be talking a little bit about tax considerations today. That's one aspect of my practice. I do a lot of work with key executives in mergers and acquisitions, focusing on design, implementation, and again, tax with respect to those types of awards.
All right. And then before we kick off our program, I do have a few housekeeping items to go over. First, at any point during the presentation, you can submit questions by using the Q&A button at the bottom of your screen. Time permitting, we'll address any questions at the end of the presentation. If you're having any audio or technical problems, please use that same Q&A button, and our marketing team will work to get those resolved. And then finally, you will receive a copy of the presentation materials and a link to the recording by email after the program, so there is no need to write everything down. Okay, next up, here is a quick overview of what we'll be going through today. All right, next slide. Thank you. So, Nona, I know we've both been keeping busy with deals lately, and a key component to a lot of these deals has revolved around transaction bonuses and other types of incentive compensation that are triggered on the closing of a change of control. What are the main types of incentive compensation that you have seen lately?
Yeah, so I would definitely say rollover equity. That is a frequent feature of deal-related comp in many of the private company acquisitions that I've worked on lately. We also, of course, see cash bonus payments keyed to deal proceeds, sometimes deal proceeds over a hurdle. Another common structure is phantom equity or equity appreciation rights that settle in the event of an exit event or significant investment. And the latter two are sometimes created near in time to a closing. Rollover equity will go into a little bit more. Typically, that is in place, some period of time prior to closing, sometimes a matter of years. But yeah, we'll talk about variations on that theme.
Right. I think I've also seen a shift in who is receiving these incentives to include larger incentives for the broader C-suite, some VPs and individual contributors, as well as the occasional consultant. Has that been your experience as well?
I would say it's becoming more common. In the context of rollover equity, for the group involves individuals who are not founders or other pre-deal owners. I'd say there's special considerations, but I do see this, and people are getting more used to this type of incentive because it is a great go forward incentive. So people are it's more commonly really vetted leading up to closing, and some of those considerations I would say are withholding. Is there going to be tax liability for individuals who are not pre-closing owners? So sometimes this takes the form of a required reinvestment of cash transaction proceeds that are being delivered to the individuals who are very much key service providers but aren't giving up their equity as part of the transaction. So that's, it's very important to map those out and sort of categorize the different groups of people that are going to be receiving this incentive. I do think with, you mentioned consultants, advisors. This is also a feature of, sort of the package that we're seeing presented in a lot of transactions. There, the tax issues can actually be easier because typically there's not going to be withholding. And sometimes withholding is one of the most, it can be a little bit time consuming logistically, so that can be helpful. But it's just, there will typically be a separate set of vesting conditions for those types of contributors, because it's not just continued employment. It's what are they doing in their advisory role.
Right. Well, and you mentioned consultants. I think another kind of component with that is, are these individuals who should really be getting these awards and these types of incentives? Because, you may inadvertently create an employment relationship that you don't want to. So I think there's a lot of very specific considerations to take into account.
Right.
Another aspect somewhat related to who is receiving these incentives and what types of incentives are being used is the inclusion of restrictive covenants, releases, retention components. I think each of these components comes with its own considerations that we don't really have time to go into great detail on in this forum. But are there any key considerations that you see playing into this aspect of plan or incentive design?
Sure. So I would say number one, and probably, most straightforward, is the desire to obtain a release. And, this is in the private company context, the public company context, either built into pre-existing agreements that might pay out on a change of control or other exit, significant investment, or in the creation of sort of near in time incentive documents. A release is very important. And what that's really trying to do is just capture and really, for valuable consideration, which these incentives are, sort of address and eliminate any prior employment concerns, get those claims out of the way and covered in the release. And it's really standard requirement, of a buyer to see that. So that's important. Certainly with the FTC ruling recently, restrictive covenants are, that's going to be a moving target. I think one of the important things to think about there, which has not, to my understanding, and this discussions I've had, in the past week or so, has not been fully fleshed out, is, can certainly non-competes and then other restrictive covenants be present as a contractual condition to payment, even if it's something that cannot be, sort of equitably enforced, because that, if it becomes final, would be prohibited. So the contractual inclusion of restrictions is still, being fully vetted, and will certainly be important, to fine tune going forward for key service providers.
Right. Well, and with respect to retention, I've seen quite a bit of tension between kind of the buyer's goal of incentivizing employees to stay, just through a transaction, the seller's goal of potentially retaining employees beyond the transaction, through any transition periods or even beyond that. And then, depending on the deal structure, the allocation of the costs of these bonuses, and then the allocation of the tax deductions associated with the bonuses as well. All of these incentives are great, but who's going to pay for it? And then who's going to get the tax benefits for it? And it can be difficult to strike the right balance with all of those considerations. Beyond that, and I think something that we've certainly talked about before, is the importance of ensuring that you are very carefully designing these incentives to not only accomplish the appropriate organizational goals and ensure compliance, but to also be practical to administer. If an incentive is designed to require an executive to stay for 12 months post-closing, but the bonus is fully paid within 30 days of closing, you would need to incorporate a clawback provision, which could be entirely impractical in certain circumstances, especially when you start looking at the tax implications that can go along with that. Would you agree?
Yeah, and actually, I think that's a good observation because in some ways, mention of clawbacks and that being thrown around is another thing that I would almost call a trend. I've heard more about that as, hey, what about this or a potential comp element in the past couple of years than I have, in a while. And those can serve an important purpose for very, for the most key people where it's essential for whatever business reason to make the payment currently subject to clawback. But I will tell you, it can be very punitive and difficult to administer if the clawback period stretches beyond the calendar year of the payment. So I would say limited in scope would be the baseline, and consider other alternative structures would probably be preferable because the tax results can be surprising and they're pretty punitive. I think I would also, add parties are becoming educated and getting more used to carefully planning for the economics of the deduction. In the last year, there's been a Seventh Circuit case that really sort of, I don't know, it was not the result that was consistent with historic practice across practitioners, and so it sort of changed the playing field a little bit. And I think that, the result of that is simply to be aware of what's currently the law, at least in the Seventh Circuit, and plan for it. The economics can be worked out, but it's just dealing with another part of planning. I think quickly, just other considerations that both, they may be sort of have different implementation for a private company or a public company, but a theme that I see consistently is a desire at the time of a transaction to modify, for whatever reason, for all executives, some executives, the terms of existing employment agreements. Sometimes there's an idea to just pay those out, start fresh. Sometimes there's a desire to extend vesting. But in any event, that needs to be vetted for Internal Revenue Code Section 409A. Sometimes it's easy, there's no restrictions, sometimes there are limitations. Also, change of control wouldn't be a change of control without parachute payments. And Section 280G. Section 280G imposes tax considerations, sometimes penalties, both for private companies and public companies. Two different methods of addressing those. They can be addressed, but it's really important to very early on. Buyers expect this. Buyer expects this analysis to be done, and for a seller to rep that there are not going to be any consequences, and to do the work, to mitigate those sort of in advance and upfront.
Right. Precisely. Well, I think that actually brings us to the end of today's presentation as well. If you submitted a question and we haven't had a chance to get to it, we will reach out to you after the fact to respond. If you have any other questions that you have not had a chance to submit, please feel free to reach out to myself or Nona, and we'll be happy to discuss with you. Let's see.
All right.
Thank you so much for attending today's program.
Thanks, everyone.